Your next reading is Portfolio Risk and Return Part 2, and these are the specific learning outcome statements. The first value says describe the implication of combining a risk-free asset with a portfolio of risky assets. So that is exactly what we did in the previous reading, Portfolio Risk and Return Part 1. What it all involved, when we combine a portfolio of risky assets with a risk-free asset, we can improve the return risk characteristic of the portfolio, resulting in a better trade-off. That's what we discussed in our previous reading. So the combination of risky assets with the risk-free rate results in what we call the capital allocation line. We discussed it in detail in the previous reading. And how the investor would allocate his assets, the proportion of allocation to the risky assets versus the proportion of allocation to the risk-free asset, it will be entirely dependent on the risk preferences of the investor. Then what about the expected return of the portfolio, the composite portfolio that contains the risky assets and the risk-free asset? We will discuss it through an equation in the subsequent LOSs. So let us move on. The next LOS says explain the capital allocation line and the capital market line. Now, this is your capital allocation line we discussed in your previous reading, Portfolio Risk and Return, Part 1. So, what it shows the combination of risk-free asset, this here, and risky asset. The risky asset basically is the portfolio available to the investor, multiple portfolios available to the investor. So this line we discussed in the previous reading is what you call the capital allocation line, and we discussed how it was derived. So now let's see what about the capital market line. So capital market line, basically it is a special case of capital allocation line. How does it make it different from the capital allocation line? The difference between the capital allocation line and the capital market line is that for capital allocation line, it is made up of allocation between the risk-free asset and a risky portfolio for an investor. Whereas in capital market line, the risk portfolio is the market portfolio. That's the difference. The investor defines the market to be its domestic stock index. That is a collection of all the stocks in that particular market, and the expected return of the market is expressed as the expected return of that index. Let me show you here. From our previous reading, we would know that the risk return characteristic for the potential risky asset portfolio, it can be plotted to generate a Markowitz efficient frontier, as you can see here. So the point where the risk-free asset touches or is tangent to this Markowitz portfolio, this is what gives you the market portfolio. And the line that you see here, the line that connects the risk-free asset with this market portfolio is the capital market line. Okay, how about calculating the return for capital market line? Okay, as you can see, let's say if we have a weight 1 of our investment invested in a risk-free asset, and the corresponding 1 minus weight 1 would be the investment in the risky asset generating this return ERM. Now, we know that the portfolio variance of two assets is calculated by using this formula. Weight 1, variance, weight 2 squared, variance plus 2 times weight 1, weight 2, the coefficient of correlation and standard deviation for asset 1 and standard deviation for asset 2. Since we know that the risk for risk-free asset is 0, right? So that would mean that this factor will become 0. Here the standard deviation, that is representing the risk of risk-free asset, and here same, the variance for risk. So these two terms will become nil, this one and this. So what you will have in the end, you will just have the standard, that's the variance, weight 2 squared, and the variance of the risky asset. Now, if you take the square root, that will become the standard deviation of the portfolio, and we have just represented the weight 2 as 1 minus W1. So it's going to be 1 minus W1 squared now becomes simple value, and this variance is now simply the market portfolio. That is the standard deviation of the market portfolio. Now let us draw the CML equation. This is the equation of a line, linear equation, y is equal to a plus bx. Let us draw this now. Our a represents the y-intercept, which in this case is RF. Okay. And on the x-axis, we have the standard deviation of the portfolio. So this would represent your x. On the y, we have expected portfolio return. Fine. Now this is what we want to find out. The gradient of the CML line. For gradient, you need to have 2 points. The first point has 0x and RF as y. And the second point has standard deviation of the market portfolio and RM as y. So if you apply the formula for calculating the gradient, that is y2 minus y1, y1 here is RF upon x2 minus x1. So x1 here, x2 here is standard deviation market portfolio, and x1 is 0. So what you get is the expected return, the market, minus risk-free rate upon the variance of the market portfolio, standard deviation market portfolio. So this is what has been replaced in place of B. So this is now the equation, the capital market line equation. RF, this is the beta, or what you call the slope of the capital market line, and then this represents x. So your equation now can be written this way: RF plus standard deviation of market portfolio ERM minus RF. This is the one. Okay, now what is the implication now? An investor who chooses to take no risk, he will earn the risk-free rate, right? And the investor who is willing to take on risk, he will earn an additional return called the market risk premium. Okay, now if we assume that investor can both lend at the risk-free rate and borrow at the risk-free rate, so they can select portfolios to the right of the market portfolio. Like here, the entire investment is in the risk-free asset. Here, 50% in risk-free asset, 50% in the market asset, 75% in market, and then 100% in the market. So this part of the capital market line, these portfolios here, they are the lending portfolios, and to the right of the capital market line beyond M, these are the borrowing portfolio. As I just said that the investors can both lend or borrow at risk-free rate, and they can select the portfolios to the right and left of the capital market line. So those investors who believe that the prices are informationally efficient, they will simply follow the passive investment strategy we discussed in our previous readings. So that is just invest in an index of risky assets that serve as a proxy, or otherwise the investor will follow the active portfolio management strategy if he believes that the prices are not informationally efficient. The next LOS says explain systematic and non-systematic risk, including why an investor should not expect to receive additional return for bearing non-systematic risk. First of all, systematic risk, as we discussed earlier in the previous reading, it's a non-diversifiable market risk. It cannot be avoided. Like we cannot avoid inflation, we cannot avoid interest rate risk, we cannot avoid, of course there are ways to do it, but this is something that everyone faces. Inflation, interest rate, business or economic cycle, every business, every firm is affected by these risks. That's why it's called the risk of the system, and that's why we call it systematic risk. When we say non-systematic risk or specific risk, these are asset-specific risk. Risk specific to a unique investment, unique company where you're investing. This is something that can be, this is N basically, can be diversified away. Like industrial actions, discovery of major oil and gas reserves, so on and so forth. So here is an important point to make. The investors are only compensated for bearing systematic risk. There is no compensation for non-systematic or specific risks. The reason, this is also called the diversifiable risk. Now let's imagine if there is some compensation for diversifiable risk. Let's say this is a particular asset and there is some compensation for taking on the risk of investing in this asset. So the demand for this asset and such diversifiable assets, it will keep on increasing, pushing the prices to infinity and return to zero. So that's the reason there is no compensation for non-systematic or diversifiable risk. Next LO says explain return generating models, including the market models and their uses. A return generating model basically is one that can provide investors with an estimate of the return that he can earn from a particular security given certain input parameters. So there are two models, multi-factor model and then single index model. When we say multi-factor model, this model uses various factors, macroeconomic fundamental factors, statistical factors, inflation, interest rate, taxes, business confidence. So these factors are correlated with the returns of the security. For example, let's say if there is a high GDP growth rate, this will positively affect the returns on this investment. Consumer confidence, if there is high consumer confidence, there will be of course higher returns. Earnings growth, firm size, there are many factors. So it's more or less like a multiple regression model that we have studied in our statistics in the undergraduation course. That is y is equal to a plus b1x1 plus b2x2 plus b3x3 and so on, bn xn. But in this context, it's going to be the expected return, risk-free rate, and then of course various factors with their coefficients. So as you can see, this model states that the expected excess return. Now what is excess return? That is ER minus RF. So if you just take RF to this side, so that would be the excess return. That is the return above the risk-free rate. So the excess return for a certain asset is the sum of each factor sensitivity. This beta 1 represents the factor sensitivity, also called the factor loading, multiplied by the expected value of that factor for the period, plus beta 2 plus expected value of that factor for the period. So adding these all up will give you the expected excess return. That is your multi-factor model. Next we have single index model. Single index model basically it's a single factor linear model that uses the market factor as the only factor. So this model basically is driven from the capital market line. The model equation is actually a rewrite of the capital market line. So your expected return on portfolio becomes the expected return on the asset. RF to the other side, that will give you the excess return, is equal to the volatility of the return on the asset upon the volatility of the market portfolio, and rest is this part, numerator is the same. And this is right here is what you call the factor weight or loading, and it shows the ratio of the security risk to the market risk. Okay, now here we go. Now this is the direct application of a single index model in the market model. So here RI stands for the return on the asset. This basically is alpha I. Alpha I is the intercept, y-intercept of course. Beta I is the slope coefficient. RM is the market return, and EI here represents the abnormal return on the asset. Abnormal return here means the return above its expected return. Okay, your next LO says calculate and interpret beta. What is beta? Beta basically it is the sensitivity of an asset's return to the return of the market. Beta basically is to measure the risk of the system, or it captures systematic risk. It can have positive value, it can have negative. When we say beta is positive, it means return of an asset move with the market, up or down. When we say the beta is negative, that means the return of an asset, they move opposite to the market. If the market goes up, the returns fall for this asset and vice versa. How do we calculate beta? Beta is correlation of asset to the market times the risk of the asset here, given by standard deviation, upon the risk of the market. We just need to plug in the numbers and we will get our value. So there are some important points to discuss. If the beta is greater than 1, absolute value, it means it is more responsive. I'm not talking about negative or positive, just the absolute value. If it is greater than 1, it means then it is more volatile than the changes in the market. It will react more than the changes in the market. Let's say if it's positive, if the market goes up and the beta is greater than 1, that asset will show high return and vice versa. Conversely speaking, if the beta is less than 1, then the asset will be less volatile, it will be less reactive than the changes in the market. So you can just interpret this way: if the market goes up, it will move up slightly, and if it falls, and when the beta is exactly equal to 1, it means then they move up and down in the same way. That is, they respond in the same way. Okay, now let's just do some basic maths for beta. Let's take 3 cases. Case 1. Given that the risk of the market is 20%, what is the beta of a 10 million treasury bill? The beta would be 0 because it is risk-free. Case 2. An asset has a standard deviation of 15% and the market correlation of 0. What is the value of beta? Of course, beta would be 0 as per the formula we discussed in the previous slide. And in the third case, what is the beta of an asset with the standard deviation of 15% and a market correlation of 0.8? Given that the market standard deviation is 10%, what would be the beta? We know the formula in the previous slide. Let me show you this one. So beta is going to be the coefficient of correlation of the asset to the market, that is 0.8 times 15% upon 10%. So if you simplify, it's going to be 1.2. So this is greater than 1, which means it will be more responsive to the changes in the returns on the market. So that ends your LOS, calculate and interpret beta. Next we have explain the capital asset pricing model, including its assumption and the security market line. What is capital asset pricing model all about? CAPM is a model to ascertain expected return of a security or an asset. The primary determinant in the capital asset pricing model is the beta. Beta as a capture of systematic risk. And this would be the equation that we will use in CAPM. Expected return on the asset, risk-free rate, beta as discussed in the previous LOS, and the excess return, the premium, that is the expected return on the market minus risk-free rate. There are certain assumptions to this model. First, investors are risk averse. They are rational and they are utility maximizing. We discussed this concept in the previous reading. What is utility maximizing? The investor wants high returns. Every investor wants higher returns. And then what does it mean by being rational? Rational means every investor analyzes available information correctly to arrive at rational decisions. Second assumption is that markets are frictionless, including no transaction costs and no taxes. Of course, it's a debatable assumption. How can it be? There are always invariably some transaction cost. Taxes, you can't avoid taxes. Deaths and taxes can't be avoided. They are inevitable things. So markets are frictionless, including no transaction costs and no taxes. When we say frictionless, means unlimited short selling as well as unlimited borrowing at risk-free rate, which is again a questionable assumption, but nonetheless it's an assumption that makes this model work. Then effects of any transaction costs, taxes are assumed to be immaterial, as if they don't exist. So if investor plan for the same single holding period, all investors, still we assume that the CAPM will hold. It will not severely limit the applicability of CAPM. Then investors have homogeneous expectations or beliefs. A questionable assumption, but nonetheless that is needed. Assets valuations are identical and same optimal portfolio of risky assets is generated. So the market portfolios are the same. The next assumption is all investments are infinitely divisible. Investors can hold fractions of assets. And then investors are price takers, mean no one or not a single investor can influence the prices by their trades. Okay, here we go. This is your security market line. First we discussed the capital allocation line. That is the combination of risk-free asset and the risky portfolio. Then the capital market line. And then we have the security market line. So here we have representation of CAPM with beta reflecting the systematic risk. Similar to the capital market line, the y-intercept represents RF and the slope of this line is the market risk premium. So please note, in the capital allocation line and the capital market line, we had the total risk, that is the standard deviation of portfolio, on the x-axis, but here we have the systematic risk of the asset on the x-axis. So let us derive the CAPM. We know y is equal to a plus bx. That's the linear function, linear equation. On y we have expected return on the asset. A represents the risk-free rate, that's the y-intercept here. X here is the beta. And now we need to calculate the gradient. Now how do we do that? This is the market risk market portfolio here with the beta 1. So we know how to calculate the gradient, the slope y2 minus y1, which is going to be ERM, return on the market, minus risk-free rate, upon x2 minus x1, that is 1 minus 0, so that's just 1. So this is the slope or the gradient, that is RM minus RF, or the ERM, expected return on the market, minus risk-free rate. So if you plug in these here, RM minus RF, you get what you call the equation of capital asset pricing model. The expected return on the asset is equal to risk-free rate plus beta times expected return on the market minus risk-free rate. Okay, so this is it. This is your function, the formulation of the security market line, the capital asset pricing model. And then some further on SMN and CML. CML only applies to portfolios on the efficient frontier, whereas the security market line applies to any security, whether it is efficient or it is not. Next, LOS says calculate and interpret the expected return of an asset using CAPM. This is the information given. Calculate expected return for a security given the risk-free rate is 5%, standard deviation of security is 40%, security correlation 0.8, standard deviation is 20, RM 10. So this will help us calculate the beta. Let us first calculate the beta. It is equal to correlation coefficient, that is 0.8, times standard deviation of the asset, that is 40% or 0.4, and in the denominator we have the standard deviation of the market, that is 20%, 0.2. So if you simplify, that will be 1.6. Now apply CAPM. Expected return is equal to risk-free rate plus beta and the return on the market minus risk-free rate. So plug in the numbers. Risk-free rate being 5%, beta 1.6, return on the market 10%, and the risk-free rate is 5%. If you do the simplification, the expected return 13%. So computation is fairly straightforward. Next we have describe and demonstrate application of CAPM and the SML, and calculate and interpret Sharpe ratio, Trainer ratio, M squared, and the Jensen's alpha. I've combined these two LOSs, and these are the areas covered in these two LOSs. Performance evaluation, securities selection, portfolio construction, and limitation of CAPM. And now we will discuss these one by one. First, performance evaluation. And then within performance evaluation, we will do Sharpe ratio, Trainer's ratio, M squared ratio, and Jensen's alpha. So let us first start performance evaluation, the first category, and within this, the Sharpe ratio. Sharpe ratio is given by this formula, and I'm very sure you would remember this from your quants reading. We discussed there this concept in detail. Just a quick overview. What is Sharpe ratio? It is RP minus RF, that is the risk premium, divided by the portfolio risk. So the point to remember here, the portfolio with the highest Sharpe ratio has the best performance. Then we have the Trainer's ratio. This ratio, as you can see, is somewhat similar to the Sharpe ratio, but it only considered the systematic risk. But as you can see, beta could be negative and positive, so this ratio would not work for the assets with negative betas that move in the opposite direction to the market returns. Then we have M squared ratio and Jensen's alpha, that is the fourth one. This is the formula for, you need to memorize this formula. This is the formula to calculate M squared ratio. What does it show us? A portfolio that matches the return of the market will have M squared equal to 0, while a portfolio that outperforms will have a positive value, and the portfolio that is underperforming the market will have a negative. So this is again a performance evaluation criterion, M squared. Then we have last one, the Jensen's alpha. Jensen's alpha is given by this formula. Alpha P is equal to RP minus RF plus beta the portfolio, RM minus RF. Now, if the result of this formula is positive, the portfolio has outperformed the market, whereas if the result is negative, then that would indicate underperformance. Alpha can be used to rank the portfolios, or we can use alpha to set what is the maximum an investor should pay for the active management of that portfolio. Then we have next area, security selection. Okay, now if an asset is correctly priced, it has to be on this security market line. Those assets that are undervalued, they will be below the security market line, and the assets that are undervalued, they will be above the security market line. So overvalued, they are good sell, and the undervalued, they are good buy. That is the application of the CAPM. Then we have certain other elements as well. Portfolio construction. Now securities with the positive alpha relative to the market index should be included in the portfolio, and securities with the negative alpha relative to the index should be excluded. And those securities that have a higher alpha, they should be given more weights in the portfolio because they are expected to perform better, right? Then finally, some limitations of the capital asset pricing model. First limitation is that the true market portfolio includes all assets, both financial and non-financial, which may not be investable. So that is one of the limitations. There are many other assets that are not investable, but they're not covered under the CAPM. Then different analysts, they may use different proxies for the market portfolio. That is the deviation from CAPM. Beta, which is a measure of systematic risk, beta estimation requires a long history of returns, which may not always be available. And also history is not a perfect predictor of the future outcomes. And finally, investors are unlikely to have homogeneous expectations. There will be many optimally risky portfolios and numerous security market lines. So we can't assume. There were many oversimplified assumptions in the CAPM model. So all those assumptions basically are the limitations. So we can challenge, we can bring on all these as the limitation of CAPM model. So that ends your reading portfolio risk and return part 2.